So in today's video, I'm going to be reacting to every single trading strategy. This is going to be my first time watching this video, so we're going to go ahead and chop it up together. And just putting this out there, guys, this is not in any way, shape or form mocking other trading strategies. You guys know this is not what that channel is about. We're not going to be putting people down. This is just basically how I would see this trading strategy and what I would do with it. And not necessarily trade it, because most likely I won't be trading it.
Fibonacci retracements. It is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels. To use the Fibonacci retracement tool, you first start by identifying a swing low and a swing high on a chart. Then, drag the tool from the swing low to the swing high. Next, wait for the price to make a pullback to one of these levels, ideally the 0.382 Fibonacci level, because that's the most common level where price tends to reverse from. So if price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels. Combine it with other confirmation signals to get a better entry.
What I would do with this is marking up from the low to the high is something similar to what I would do as well. And most likely I'll be looking for price to come closer to the 50%, which is basically equilibrium. I wouldn't necessarily take a trade because it's at a magical level like this 0.236 or 0.38 or 0.50 or 0.61.8. What I used to do back in the day is when price tapped here, I would jump in. But oftentimes what would happen is price would tap into it, but then it will wick past it. And my stop loss is most likely going to be within this range depending on the time frame. So if this is like the 1 minute time frame, of course it's going to be a bit lower because it's a smaller time frame, so it's going to be a smaller stop loss. But if this is like the 1 hour time frame and price is wicking through this is about sometimes a 20 pip to 30 pip wick through. There is no magical level in this whole trading thing. Just because it gets to a certain level, it doesn't necessarily mean it's going to just push off on that level to the T. Me personally, yes, I would use it for retracements. It's a good tool for retracements. For the low to the high, you would know where equilibrium is. Normally when price gets to equilibrium, it tends to push away from nearabouts that area, or if there was a POI within that area, it would tend to push away from there. But I wouldn't just jump in because it hit a 0.38. But I do understand why for beginners, this sounds a lot easier to them, and so they might want to just jump towards this. But me personally, it did flop me quite a number of times, so it wasn't something that was super reliable. But I do like how the money was traded towards that money above here. It didn't mention it, but there's liquidity up here. This push up here, we ran the money. That's that TTTM, trading towards the money.
Combine it with other confirmation signals to get a better entry. Breakout patterns. It is when price makes a sudden and significant movement towards one direction. This usually forms after the market makes a consolidation period. For example, here we can see that the price is consolidating. Then, it suddenly moves sharply to the downside. This is called a breakout. To take advantage of this, traders could use specific patterns as a guide to identify breakouts before they happen. Most notable breakout patterns includes wedges, triangles, and the rectangle pattern.
How would I use something like this, or what would I be looking at here? When it comes to price, when price is accumulating or consolidating and going sideways, in my eyes, it's just building up liquidity on both sides. So basically what he was saying regarding this is that, for example, you might want to say 2 pips beneath this, put like a sell stop down there, and if it passes it, you're tagged into the trade, and that you can capitalize on a breakout. Me, I don't do that. I don't be doing that because I'm most likely going to be the person that's in from a high and take it to this low, and then that's where most likely I'm going to be taking partials or taking profit. But you would never ever see me catching a breakout move when price is breaking out. It's because what can happen is you can end up being on the wrong side of the trades. The moment price breaks out, it might drop a little bit and then reverse on you, and all you became was the liquidity. And so this is why I don't necessarily jump in with breakouts. I like to take my trade to those who want to do the breakout trade and then pass it on to them, and they can do the rest, or take partials and let a little piece run. He mentioned a few other kind of breakout patterns, so like the triangle, the rectangle, the flag, the wedges. This used to be my go-to when I was doing retail trading, but oftentimes, whenever price broke out, I'll jump in, it will come back down, stop me out. Or I'll wait for a retest of this breakout of the flag trend line here. It would just always play me. And so I never ever found consistency in any of these patterns. And I've traded every single one of these patterns. Breakout strategy is very risky. I like to be the person in from a low and taking it towards where the breakout would be, because I know there's going to be willing participants who would want to continue my trade. And if I can see those participants, you're able to identify them because they're there. You can see people trade breakouts. Then you can just give your trade to them. Just give it to them. You know, just take my trade. It's all good. And when I say give it to them, I just literally mean exchange contracts with them at the breakout. Exchange contracts with them at these breakouts. Here, there, and here, there. So when I'm getting out of my trade, so for example, if I'm buying from here, and I take it here, and I want to close my position, I actually sell my order back. I sell it. And so when I sell it, there must be somebody on the other side who wants to buy, because for every trade, there must be two sides. So when people are doing breakout buying, so those are the people that want to buy, somebody else wants to be selling. And that's when I'm going to be selling mine.
Reversal patterns. It is when price moves in the opposite direction of the current trend and forms a counter trend. Specific patterns could be identified in a chart, which could help traders predict reversals before they happen. Most notable reversal patterns are double top and bottoms, triple top and bottoms, head and shoulders, cups and handles.
So he's talking about reversal patterns, so when price is turning the other way. How would I utilize this information here? When I see a head and shoulders, what I would used to do is I would try to either jump in when price breaks the neckline, and then jump in and catch a trade to the downside, and just hopefully it will go down. That worked a handful of times, so I wouldn't say it's anything to bank on. How I would use this is, in this scenario here, when price is making a left shoulder, head, right shoulder, I know that when price breaks out of this, there's going to be people that want to sell when price comes back to this area. And so most likely, there's going to be liquidity above the neckline. There's also going to be liquidity or stop losses above this high and this high right here. So I know, for example, if this is a false play, a false reversal, most likely the move is going to be to run the liquidity above the neckline and above the right shoulder and the head. For triple bottoms and triple tops, this here is a buy sign to retail concept traders. This here is a sell sign to retail concept traders. So what I would do then is, if I know traders want to buy from here and the stop loss is within this pool of stop losses down here, I'm going to wait for price to dip down into those stop losses or the sell stops or liquidity or the money basically, and then take it higher. So in other words, these people would have entered in the trade a little bit early. Yes, I've entered in trades like this before in the past, and they have worked out. Yes, that is correct. But what I see happening most of the time is that this liquidity gets taken up first before the real move. And it's just vice versa for this one. We run those highs first, and then we get that drop. So this is most likely what I'm looking at. This is just the same, but it's just a double top and a double bottom. This is a triple bottom and a triple top. And then cups and handles. I have no idea what this is. I'm not going to lie. For me, though, this is what I was talking about here or here. If I see like a top and another top, that to me is a double top. I would want to run the money.
Elliot wave. It is a theory that suggests that market tends to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction. By understanding the Elliot wave sequence, traders can predict where the price is heading by following the pattern. In a chart, we can label each point of the waves as 1, 2, 3, 4, 5 and ABC. Now, there are specific rules to ensure that a movement is considered as a valid Elliot wave. First, wave 2 cannot be longer than wave 1 and usually pulls back to the 0.618 Fibonacci level. Second, wave 3 must be the longest wave amongst wave 1, 3, and 5. Third, wave 4 must remain above the peak of wave 1 and usually pulls back to the 0.382 Fibonacci level.
Guys, this is way too confusing. I'm not going to lie, bro. This is just too much going on. Wave 2 must not be longer than wave 1, and it must be at 0.61, and then wave 3 must be the longest wave, and the retracement must be to a 0.38 or whatever it is. Guys, this is so confusing. This was the one pattern I just never got when I was doing retail concept trading. I'm telling you now. So look, this is how I would do it. This whole 3 waves, guys, I've seen multiple waves. I've done the whole 1 drive, 2 drives, 3 drives up, and then reversal, guys. It doesn't work all the time. It works sometimes. How I would look at this is when price retraces, make sure there's a POI that you're interested in. It could be a fair value gap. It could be an institutional candle. It could be an order block. It could be something of interest. That retracement, for me, the ideal entry will come from that POI. It doesn't matter whether it's at the 61, the 50, whatever it is, the 78 point, whatever. Guys, listen, as long as you have a POI here, that's most likely where it's going to go. I did try to do the A, B, C, D stuff. Guys, look, confusing. Once you're in for that POI, you run the money. The money's going to be above this high. There's going to be all kinds of liquidity up here. That's the money you run. And the thing is, when it creates a high and then a low, you have a POI in here somewhere. It comes back to it. That's an entry. And then if it comes to stop you out, it is what it is. Forget the whole wave 1, 2, 3, 4, 5. I've seen multiple waves. I've seen it so that it's at wave 3, it broke the low, trade through, and then smashed up to the heavens.
So here's an example of the Elliot wave in action. In this chart, we can see that the price resembles a possible 1, 2, 3 Elliot wave. And so, based on the theory of wave 4, which is that price tends to pull back to the 0.382 Fibonacci level before continuing upwards, we can use this as a potential buy entry when price makes a pullback. Fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling. To find a fair value gap, you first need to find a candle with a large body. Then, draw a rectangle at the gap. Place it between the previous candle's wick and the next candle's wick.
Yeah, this is good so far, but one thing I'll say, it doesn't have to be a large body, it can be a smaller body. It doesn't have to be a large body, it just needs to have that wick and that wick not touching.
This level now acts as a potential magnet, where price may revisit before continuing its movement.
If there was going to be any kind of entry, it would have to be from the fair value gap, because this is where there's uneven trading. They come back down, provide even trading, and then it goes. If you're scalping it down, depending on what time frame you are, I don't know what time frame this is. If you're traded down to it, this would be where you take TP. If you wanted to enter buys from here, this is a good place to enter buys from too. Once it drops, there's going to be liquidity above this high. This is where I'll run that trade to right above here.
Movement. Candlestick patterns. It is a technique that traders use to analyze future price movements by looking at specific candlestick shapes. Notable candlestick patterns include engulfing patterns, which signals strong momentum towards the direction of the engulfing candle; hammer and shooting star patterns, which indicates rejection as shown by the long wick on one side; doji patterns, which signals neutrality in the market.
Alright, let's go back. Engulfing candles. So engulfing candles, never been a fan of engulfing candles. Why? Because I've seen engulfing candles form and then price just turn around. It wasn't something to rely on. I couldn't bet my house on it, put it that way. Engulfing candles, not necessarily something that I'll be looking at as a sign that price is going to go the opposite way. Some of the things I've done in my past, I've entered in for sales from these hammer candles, or also called it pin bars, I believe, both bullish and bearish. And I've done the whole thing where you just jump in when this candlestick opens, put your stop loss above this, and it just stopped me out multiple times. When I see a wick like this, I don't let it phase me. I know price can easily come back up, trade through this whole candlestick wick high, and then go. If price then created like a fair value gap somewhere here, let's just say there was a fair value gap in here somewhere, then that would be a potential entry, but I wouldn't base it off of this. Doji patterns, it's basically neutrality in the market. When I see those candles, I just forget about those candles. They mean nothing to me. Price just didn't go nowhere. That's what it is. It didn't do anything. I look up more than just this doji candle. I like to look at, was there a fair value gap to the left that we were filling in? And so this wouldn't mean, oh, indecisiveness. To me, it just looks like we're filling in a fair value gap before going long. So that's what I would be looking at this as. It tells me nothing. It doesn't tell me anything about the markets. Put it that way.
Which signals neutrality in the market. Heikin Ashi. It is an indicator that fully replaces a traditional candlestick chart to a Heikin Ashi chart. When applied, it tends to give less noise than a traditional candlestick. A green Heikin Ashi candle signals that the price is on an uptrend, and a red Heikin Ashi candle signals that the price is on a downtrend. The size of the candle's body also indicates how strong a trend is. The larger the candle, the stronger the trend. Keep in mind that the Heikin Ashi only acts as an indicator. It does not display the real market price.
Listen guys, just stick to the normal candlesticks. I don't know what the hype is about these candlesticks, about they're more precise and less noise and all of that. Look guys, just stick to normal candlesticks.
Moon phases. It is a concept that utilizes moon cycles to time the market. Moon phase traders believe that moon cycles are correlated with human emotions and behavior, which could have an influence on the market. Specific moon phases are believed to be favorable towards a certain trend. A new moon means the market tends to be bullish, and a full moon means the market tends to be bearish. Today, it is used mostly as a confirmation tool.
Are you joking me? Are you joking me? Moon phases. I've never heard of moon phases. I think at this point, people are making up all kinds of stuff. I saw one time somebody said there's a dinosaur pattern. They drew out a dinosaur on the chart. I think people are just making up all kinds of stuff. I don't know whether you traded moon phases before. If you traded moon phases before, or you heard of it before, drop in the comments. I have no idea what a moon phase is.
Be bearish. Today, it is used mostly as a confirmation tool.
You get a full moon equals your bearish tendencies. What does the moon have to do with your emotions and have to do with the charts? No idea, guys. No idea.
Renko. It replaces a traditional candlestick chart to a Renko chart.
Bro, this looks like a whole bunch of Legos. This is something that my son will be creating when he's doing his coding or something. I don't know what's going on here. Guys, this looks like a whole bunch of Legos.
So, unlike a traditional candlestick which forms a new candle based on a certain period of time, a Renko chart forms its block based on the change of price. For example, Every 1% change in price, a Renko block appears. This means that each Renko block represents a 1% change in price. Of course, you can change the parameters of this through the indicator settings. Traders could utilize Renko charts to filter out noise and identify trends. A green Renko block signals an uptrend, and a red Renko block signals a downtrend. And keep in mind that Renko charts only acts as an indicator. It does not display the real market price. Patterns. Indicator. It does not display the real market price. Harmonic patterns. These are advanced price patterns that follows a specific shape based on Fibonacci numbers. Traders can then use these specific shapes to predict future price movements. For example, a bullish bat pattern is formed when price makes a series of 4 movements that is shaped like the letter M. Each point can be labeled as X, A, B, C, and D, and each of these points has a specific guideline. For example, point X to point B needs to have a value between 0.382 and 0.5. Point A to C needs to have a value between 0.382 and 0.886.
Wow.
And the same thing works for the other points.
Wow, guys.
Next, these specific guidelines.
Bruv, what kind of shape is this? Harmonic patterns, man. I remember these days, man, when I really tried to go in on harmonic patterns. And first, it was super confusing. I mean, so confusing. 0.382, this must be between this and that. And then once again, I believe people are just making stuff up. Bullish bat pattern, bearish bat pattern, whatever it is. The majority of these things have made some money sometimes, but it's also lost a lot of money a lot of times. How I would see something like this is, let's just say this is price. This is just an equal highs to me. Run that liquidity, run that money on the top side.
Then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline. If it does, then you can take a position based on the pattern that formed.
You know what, guys? I think for every single pattern you see here, you're going to find the chart working with it at some point on the chart. You're going to just, go through the chart. Oh yeah, here's worked. Mark it up and use that. Look, it doesn't mean that this is going to always hold, guys. Just because we've been able to see certain things here, see on these charts now, it doesn't mean it's going to keep on working, guys. All you have to do is cipher through all your charts on whatever time frame, 1 minute, 1 hour, whatever it is, and you will find something that matches up with this harmonic pattern. There's a lot more that goes into trading than just these patterns that you're seeing.
There are multiple harmonic patterns that exist. Most notable are butterfly.
Alright, let's look at these patterns here. Bullish, this is what I'll do. I'll be running that money. I'm running the money beneath this low. Bearish, there's equal lows. I'll be running that, looking to run that. Bullish, equal highs. I'll be running that. We've just taken liquidity. If price is going to retrace, this could be a retracement. If it violates my POI, we're running those equal highs. These are just all the same thing, just all different types of shapes. We had the bat, we had the crab, the butterfly, the gartley. This is way too much. This is information overload. I believe this will keep you just playing yourself. You'll be guessing, like, which one is it? Is it the crab? Is it the bat? Is this one going to run the low? Is it going to keep the low and do the bat pattern instead? Keep that to the side, keep it moving.
Bat, crab, and each have their own unique values. Support and resistance. These are key levels that formed horizontally where the price has bounced off in the past and could possibly bounce again in the future. If the level is below the price, it's called support, where you can take a buy position if the price approaches it, and if the level is above the price, it's called resistance, where you can take a sell position if the price approaches it.
Support and resistance, guys, man. Whenever I see something like this, whenever I see some kind of support like this, where price is bouncing off of a level or close to nearabouts the same level, this for me is just building up of liquidity on the top side here. And I'm looking to run that money, guys. I'm looking to run that money. The moment I get some kind of bullish POI hit or some kind of bullish sign, I'm looking to run that money right above here. This is where the money's at. All those buy stops, all the liquidity. And then when it gets there, I'm looking to offload some of those positions, guys, because there's going to be willing participants who want to take on my trade, take on my buy. And that's the breakout buyers. And also, guys, I've seen levels like this hold like this and then price wick through it big time and then drop. And so this is why you wouldn't know how to play something like this, because price could run through all those stop losses and then drop. And now you've played yourself because you decided to put your stop loss in an area where there's a pool of stop losses. That's the easy money.
Dynamic support and resistance. Similar to support and resistance, dynamic support and resistance also acts as key levels. But instead of using static horizontal lines, it uses indicators like the moving average to act as our key level.
Let's pause it right there, guys. I knew this was going to say moving averages. This was another thing we learned in my beginning days when I was trading as well. So basically, there was a moving average. They put these magical lines on the charts, and whenever price tapped it, they would expect price to then bounce off of it. I did this so many times, man. And the amount of times I got played. And the thing is as well, it's not there first. It's not there ahead of you. It's there after the candlestick is printed. You don't know whether price is going to drop through here or push off from here. You can only just say, because I believe in moving averages, price should come back to this line and it should tap it and go. You never know for sure. All I care about is prices making a high, a low, a high, and then we have a high right here, and then we have a low, and then we have a new high. So in other words, from this low to this high, all we were doing is trading within this range here. And then eventually we push up. I can see these candlesticks here. It's going to be a fair value gap in here. The one that would have been used to take price higher. Or you see this down close play here. This is a sell play all the way to run out this liquidity down here. If you extend a line, extend it out to the right, that's a down close candle. Lots of mitigation taking place at the down close candle, and then we push off.
Trend lines. Trend lines are key levels that form diagonally during a trending market. You can use trend lines to identify the overall direction of the price. Upwards trend line means bullish. Downwards trend line means bearish. And similar to support and resistance, you can also use the trend line to identify possible entry scenarios. For example, if price retraces back to a trend line, it can be a good opportunity to take a buy position.
If you draw up this magical line here, and you see price bouncing off of a magical line, eventually we're going to run that liquidity. So stop losses are being placed beneath every single one of these taps of the trend line. And then eventually we're going to get a run past to run out all the stop losses, the whole liquidity pool, and it will just drop down and run out all kinds of money. You don't really know how deep they're going to run into these trend lines. You see here, we poked our nose way beyond it. And probably on a lower time frame, there might have been a break and retest of this trend line, and it would have confused folks, and then it would have gone the opposite way. Also, remember earlier on they talked about the 3 drives, 1 drive, 2 drive, 3 drive, and a reversal. Look at this. This is a 4th drive.
Back to a trend line, it can be a good opportunity to take a buy position. Gann angles. It is a tool that displays multiple lines that spread continuously on different angles. These lines can then act as possible key levels and could also help you measure the strength of a trend.
Guys, at this point, we're just throwing all kinds of lines onto these charts and just saying, hope for the best. It's like just throwing your fishing net out into the sea and just trying to catch all kinds of fish. I have no idea what's going on here, guys. I see price doing all kinds of stuff with all kinds of different colors, all kinds of different lines. Me personally, I would stay away from this because you can't even see any kind of consistency in this. It bounced off here for some reason. I went up higher, but there's no line here, guys. So it just looks like a whole bunch of rainbow stuff to me.
Price moving within the steep angles of the tool indicates a strong trend, and price moving within the shallow angles of the tool indicates a weak trend. To apply the Gann angles, first you go to settings, then make sure to check the lock price to bar ratio. Next, identify a market range and mark the swing low and the swing highs of that range. Then, draw a straight vertical line at the start of the range. After that, select the trend angle tool and measure 45 degrees. Then, use the Gann fan tool and place it at the 45-degree angle.
Doing too much, guys.
Momentum indicators. These are the types of indicator that measures the direction and strength of a trend. It is most effective when used in trending markets. Some of the most notable momentum indicators are MACD. An upwards crossover indicates a bullish trend, while a downwards crossover indicates a bearish trend.
I've done this before, guys. It's lagging. It doesn't tell you beforehand. It tells you afterwards, and after the move's probably already taken place. Most of these indicators are lagging indicators, so they tell you after the move has actually happened.
Moving averages.
Moving averages. We spoke about this one already.
Price being above the moving average signals a bullish trend, and price being below signals a bearish trend.
Same thing, guys. If you're above, you're bullish. If you're beneath, you're bearish. Guys, all of these indicators are lagging. Most likely, you're going to be trying to jump into a trade after it's already moved.
Parabolic SAR. A dot below the price indicates a bullish trend, and a dot above the price indicates a bearish trend. Super trend.
A super trend? I've learned some new trading language right here, guys. No wonder why so many people are confused. How do you know which one to pick here, guys? How do you know which one to pick? There's so many. You're jumping from one strategy to the next one, to the next one, to the next one. No wonder you guys are giving up so much.
Green signal indicates a bullish trend, and the red signal indicates a bearish trend. Oscillators. These are the types of indicator that displays the relative strength of a price. It is most effective when used on choppy or sideways markets. Most notable oscillators include RSI. When the line is in the oversold region, it indicates a possible reversal to the upside. If it's in the overbought region, it indicates a possible reversal to the downside.
I don't believe none of this stuff, man. I stopped using RSIs about 4 years ago. I've seen RSIs within this overbought side. And one of the things I do with my mentees is that I can kind of predict when prices are going to be in an overbought. And I'll just tell them, look, right now, lots of retail concept traders are thinking that price is overbought. And they think price is going to go to the downside, but watch it shoot up to the upside. I would see this happen so many different times. And it will just go ahead and continue to run up higher. From when that was happening, guys, I stopped using RSIs a long time ago.
Stochastic. If both lines are at oversold, it signals a possible reversal to the upside, and if both lines are at overbought, it signals a possible reversal to the downside. These two
But this just reminds me of the RSI, and it's just extra, the added lines.
two lines can also cross over each other to predict future price movements. Divergences. Divergences occur when an indicator displays an opposite signal of the real price movement. When this happens, it is usually a sign that the trend might reverse.
Yeah, guys, so when it comes to divergence, yeah, so this is something that some people actually use in confirmation with other trading concepts. I would never use this stuff down here because I just believe it's just inaccurate. It's very lagging, doesn't really do anything. But I'll just normally pull up two pairs. Let's just say Euro USD and GBP USD. They tend to correlate probably 99% of the time. And then there's going to be one time that, for example, let's just say Euro USD is like this, where you create a high and a higher low. And then G might do a high and then a lower low. And then DXY would just be the opposite of Euro USD. And it just means that Euro USD is going to be the pair that shoots to the upside more than GU. That's how I kind of use it. I use it every now and then. So, but I would never use none of this stuff down here, guys.
The real price movement. When this happens, it is usually a sign that the trend might reverse. Divergences could occur in many indicators such as the MACD, stochastic, and the RSI.
All
For
kinds
example,
of indicators,
here,
man.
using the MACD indicator, you can see that the price is forming higher highs, which is bullish, but the indicator shows the opposite, a lower highs, which is bearish. In this case, this is a bearish divergence, which signals that the price may form a reversal, and so you can take a sell position. Volume indicators. These are types of indicator that shows the strength behind a price movement by tracking the trading volume. Notable volume indicators include price volume, which displays the volume for each candle. The longer the bar, the higher the volume.
So when it comes to volumes, guys, I don't use it at all. Once again, everything's lagging here. I don't use this stuff. I'm not saying if you went ahead and used this, you're wrong. You can do what you want, really. So some people like to use this, and it is what it is. It gives them extra confirmation, especially for those who trade Wyckoff and stuff like that. But for me, I stay away from volume indicators. It don't really mean much to me. I'm also looking at these fair value gaps in here, order blocks and stuff like that. I'm not necessarily looking at these volume indicators.
Volume indicators include price volume, which displays the volume for each candle. The longer the bar, the higher the volume. Volume weighted average price, which shows the ratio of an asset's price to its total volume. It can be traded like a moving average or as a dynamic support and resistance. Volume profiles. It displays a volume bar horizontally, which can be treated as key levels for potential entry positions. Supply and demand. Also referred to as order blocks, these are zones where significant price movements have occurred. If price moves significantly upwards from a level, it is considered a demand zone. And if price moves significantly downwards from a level, it is considered a supply zone. Just like support and resistance, these zones can be treated as key levels for potential entry positions.
Never used supply and demand in my entire life. I remember when some people were saying, oh, am I a supply and demand trader? Never have traded supply and demand. In this scenario here, I wouldn't be expecting price to bounce off of this level when it came back. No way. I'll be looking for price to burn through this level. I ran at liquidity on the top side. Why? Because we never ran through this low here. And there's a down close candle in here.
As key levels for potential entry positions. Market structure. Market structure is when trader analyzes the behavior, condition, and flow of the market. An uptrend structure is characterized by price forming higher highs and higher lows, while downtrend structure is characterized by price forming lower highs and lower lows.
This is a staple. This is like one of the first things you learn when you're trading. Lower lows and lower highs, very important. Higher highs and higher lows, knowing what kind of conditions the market is in. Is it in a trending market? Is it in a market that is consolidating? Is it in a market that is retracing? Knowing this is vitally important, obviously, because it's going to help you get into the right trade and take it the right distance. This is that pure price action trading. No indicators needed, just a plain old chart and looking at simple candlesticks.
Breakout structure. It is when price breaks the previous price peak during a trend.
Yeah, guys, this is just the same as market structure, guys. Same thing, man. Look, higher high, high low, high high, consolidation. I've told you guys this before. When prices retracing, it's the same thing as when prices going sideways. The whole idea behind this retracement is to generate liquidity above these highs to run it later. Same thing here. Generate liquidity above this high, yeah, to run it later.
For example, if the price forms a higher highs and higher lows, this break of the previous highs is called break of structure. Change of character. It occurs when price breaks the previous structure during a trend.
Guys, same thing, man. Look, it's just when price turns around. Look, higher highs, higher lows. So here, all the buy stops are being taken out every single time. You have buy stops above here, you run it. You retrace, buy stops above here, we run it. We retrace, buy stops above here, we run it. There's a retracement, but then eventually price runs through this low right here. It means that price is basically turning around. And then what you would do, you look for price to return up into where? A fair value gap or into a buy candle where you should expect to see some kind of selling and take it to the downside. It's the same thing as market structure, same thing as the breakout structure, just explained in different ways.
Often signaling a reversal from that current trend. For example, if the price is forming higher highs and higher lows, then it breaks the previous lows forming lower lows. This is called a change of character.
So guys, that was my take on every single trading strategy according to this video.